Hello, and welcome to our first-time home buyers class. I'm here to help you avoid costly mistakes on your journey to homeownership. Today, we'll cover essential steps, programs, and pitfalls to watch out for, ensuring you feel confident and prepared. Let's get started by understanding how you might be feeling as a first-time buyer. As a first-time home buyer, it's normal to feel overwhelmed. This slide highlights some common emotions. Are you feeling concerned about the process? Stressed out by the financial commitment? Intimidated by the paperwork? Anxious about making the right choice? Or uncertain about where to start? Don't worry, we're here to guide you through every step and turn those feelings into excitement and confidence. Let's explore the challenges of being a first-time buyer. Being a first-time home buyer comes with its challenges, especially in a market like Arizona's. You might face high competition, with homes selling fast and prices rising, making it tough to find the right property. Understanding complex mortgage terms, like debt-to-income ratios or loan limits, can feel daunting without guidance. Financial hurdles, such as saving for a down payment while managing other expenses, often add stress. Plus, navigating the paperwork and legal requirements can be overwhelming if you're new to the process. But don't worry, with the right support, you'll overcome these challenges and find your dream home. Let's meet the expert who will guide you through this journey. Let me introduce Todd Uzzell, your dedicated mortgage loan officer. Todd brings extensive experience to the table, specializing in home purchases, refinances, and investment property loans with deep industry knowledge. He supports a wide range of home buyers, including first-timers like you, as well as those upsizing, downsizing, or investing, catering to all life stages. Todd is committed to making the home buying process seamless, expertly navigating its complexities for a smooth experience. He's also skilled at helping buyers with little to no money down, making homeownership more accessible. On a personal note, Todd is an avid outdoors enthusiast and a proud father of two, deeply rooted in Arizona and Texas communities. With Todd by your side, you're in great hands. Now, let's outline the steps to homeownership so you know exactly what to expect. First, attend this class to learn everything you need to know. Start by getting pre-approved with your mortgage broker. Visit Todd at todduzzell.com. Next, qualify as a first-time home buyer with guaranteed approval. Then, go house hunting with your realtor to search and find the perfect home. Once you've found it, make an offer and negotiate the terms. After that, conduct a home inspection and condo review if applicable. Finalize your financing, waive any contingencies, sign the paperwork at the lawyer's office in some states, and finally, move into your new home. These steps will guide you to success. Mistake number 1: ignoring the first-time home buyer incentive program. Let's define a first-time home buyer grant. It's a financial assistance program specific to your region, dependent on your income, often structured as a forgivable second mortgage, meaning you might not have to repay it if you meet the terms, and it provides down payment assistance to help you afford your first home. These grants are designed to make homeownership more accessible for buyers like you. Let's see an example of how this works. Here's an example of how a first-time home buyer grant can help. Anita wants to buy a home. The purchase price of her new home is $400,000. The minimum down payment at 3.5% is $14,000. The FHA upfront mortgage insurance cost at 1.75% of the total loan amount is $7,000, not paid upfront, but added to the loan. With a 3% incentive of $12,000, the total down payment is covered by the incentive, leaving $7,500 for closing costs. This example shows how grants can make a big difference. Next, let's explore the types of mortgages available. These are the main types of mortgages available to you: conventional, FHA, USDA, and Virginia. Each type applies to different scenarios. For instance, an FHA loan might suit someone with a lower credit score, while a VA loan is perfect for veterans looking for zero down payment options. Let's see how first-time homebuyer programs work. Let's look at how first-time homebuyer programs work with a couple of examples. The Arizona Housing Finance Authority offers down payment assistance up to 5% of the loan amount, which can be used for an FHA loan, helping buyers cover their 3.5% down payment and some closing costs. Another example is the Home in 5 Advantage program in Maricopa County, which provides up to 4% assistance for down payment and closing costs, often paired with a conventional loan for eligible buyers. These programs make homeownership more affordable. Let's dive into FHA loans next. Here's what you need to know about FHA loans. An FHA loan provides mortgage insurance on loans made by FHA-approved lenders across the USA, protecting lenders and allowing more flexible terms for buyers. Because of this backing, FHA loans often have lower down payment requirements and more lenient credit score criteria, making them a popular choice for first-time buyers. Let's explore their benefits. Here are the benefits of FHA loans. They offer a low 3.5% down payment with a 580 credit score. You can qualify with a credit score as low as 500 with 10% down. They provide easy refinancing with the FHA Streamline program. FHA loans come with low mortgage rates. They accept higher debt-to-income ratios. You can choose between a 15 or 30-year fixed rate or an adjustable rate term. Down payment assistance programs or grants are accepted, and the seller can pay closing costs up to 6%. These benefits make FHA loans a great option. Let's check out conventional loans. Let's define a conventional loan. A conventional loan is a home buyer's loan that is not offered or secured by a government entity. It is available through or guaranteed by a private lender or the two government-sponsored enterprises, Fannie Mae and Freddie Mac. These loans often have stricter credit and income requirements but can offer higher loan limits, making them suitable for buyers with strong financial profiles. Now let's compare FHA and conventional loans. Let's compare FHA and conventional loans, focusing on key differences that matter to first-time buyers. When it comes to down payment minimums, FHA loans require just 3.5%, while conventional loans start at 3%, but conventional often requires a higher credit score to get that low rate. For debt-to-income ratios, FHA loans are more flexible, allowing up to 56%, which is great if you have student loans or other debts, while conventional caps at 50%, so you'll need a stronger financial profile. As for loan limits in 2025, FHA loans max out at $546,250, while conventional loans go up to $806,500, giving you more purchasing power in high-cost areas like parts of Arizona. These differences can help you decide which loan fits your situation best. Let's move on to what you can use for your down payment. Here's what you can and can't use for your down payment and closing costs. You can use 401k or retirement accounts, gifts and stock, bonds, or cash. You cannot use credit cards, loans, or undocumented cash. For example, I once worked with a buyer in Arizona who used a generous gift from their parents to cover their down payment. It made the process so much smoother. Just make sure your funds are documented, and you'll be set. Let's see what makes you eligible for a loan. Let's look at what makes you eligible for a mortgage, based on an underwriter review. First, your ability to repay the loan, proven by your income and debt-to-income ratio. Second, your willingness to repay the loan. You sign an intent to proceed document. Finally, the collateral. The house must appraise for the sales price or higher. This ensures the lender that you're a good candidate and the property is a safe investment. Let's move on to the next common mistake to avoid. Here's the second mistake to avoid: not getting pre-qualified. Pre-qualification helps you determine how much you can afford to spend on a home based on these three factors: your credit, your income, and your assets. Pre-qualification can help you determine what house you qualify for, increase your bargaining power when negotiating with a seller, estimate your monthly payment and total investment, and identify which loan product will fulfill your needs. Don't skip this step, it's crucial for a successful home buying journey. Let's talk about the pillars of a mortgage approval. They are credit, income, and down payment. For example, a strong credit score, like 700 or above, can get you better rates, while a lower score might require an FHA loan. Your income needs to show stability, like a steady job for 2 years, and your down payment could be as low as 3.5% for an FHA loan, or even less with a grant. These pillars are the foundation of your approval process. Let's dive deeper into pre-qualification. This slide covers loan pre-qualification. Pre-qualification helps you determine how much you can afford to spend on a home based on these three factors: your credit, your income, and your assets. Pre-qualification can help you determine what house you qualify for, increase your bargaining power when negotiating with a seller, estimate your monthly payment and total investment, and identify which loan product will fulfill your needs. Let's see some tips to make this process easier. So, you're ready to get pre-qualified? Let's make it simple with some tips. Here's what to do. Call us if you have any questions. Continue living at your current residence. Keep paying your mortgage or rent. Continue to use your credit as normal. Keep working at your current employer. Keep your same insurance company. Stay current on all existing accounts, and expect requests for additional documentation throughout the process. Now, here's what not to do. Don't make any large purchases, change bank accounts or make large cash deposits, transfer balances, close any credit card accounts, consolidate your debt onto 1 or 2 credit cards, apply for new credit or take out a new loan or co-sign on a loan, or max out or overcharge on your credit card accounts. Following these tips will keep things smooth. Let's compare pre-approvals and rate holds next. Let's look at the difference between underwritten pre-approvals and rate holds. Pre-approvals are underwritten. Review income, review credit, review down payment source, are reliable, and tell you a maximum qualifying amount. Rate holds simply hold an interest rate. Understanding these options helps you choose the best path for your home buying journey. Let's see the benefits of a guaranteed pre-approval. Let's talk about the benefits of a guaranteed pre-approval. It's a game changer. With a guaranteed pre-approval, you can shop with confidence, knowing exactly what you can afford. Plus, there's a $500 money-back guarantee, so you're covered if things don't work out. The savings from this peace of mind are priceless, especially for first-time buyers in Arizona looking for their dream home. Let's move on to the third mistake to avoid. Here's the third mistake to avoid: using your bank. Most banks will charge an origination fee or discount points. In large banks, you're just one of thousands of clients. To them, you're just a number. Large banks typically have stricter guidelines that will not cater to specific situations outside their general box, and they may not offer down payment assistance programs. Let's see why bank penalties can be costly next. Bank penalties can be expensive if you need to prepay your mortgage. Percentage of balance on a sliding scale: 2% in year 1, costing $8,000, or 1% in year 2, costing $4,000 on a $400,000 balance. Interest rate differential, or IRD: 1.2% spread over 3 years, so $400,000 times 1.2% times 3 equals a $14,400 penalty. 6 months interest. At the current 4.65% rate, 6 months interest on $400,000 equals a $9,300 penalty. Flat fee penalty: a fixed $5,000 charge for early payoff within the penalty period. These costs add up fast. This slide is all about posted versus discount rates. Posted rate is generally lower than the actual rate. The fine print will show that the lower rate carries a cost of 1 to 2% or more. For example, if a bank advertises a 4% posted rate but the actual rate is 5%, you might pay a 1% fee on a $400,000 loan. That's an extra $4,000 just to get the lower rate. Knowing the true cost helps you make smarter choices. Let's look at more bank penalty examples next. Let's look at a couple more examples of bank prepayment penalties to see how they can impact you. First, some banks might charge a penalty based on lost interest. For a $400,000 loan at 4.65%, if you pay off early with 2 years left, they might charge $18,600, the interest they'd lose over that time. Another example is a tiered penalty. One bank might charge 3% of the balance in the first year, so on $400,000, that's $12,000, dropping to 1.5% or $6,000 in year 2. These penalties can really add up, so choose your lender wisely. Let's move on to the fourth mistake for first-time homebuyers to avoid. The fourth mistake to avoid is buying directly from a builder. This can cost you between $5,000 and $40,000, often included in the cost of the home. Always take a realtor when visiting a new build community. Let's check out the specific costs of this mistake. Here's the cost of buying straight from a builder. It can range from $5,000 to $40,000, often included in the cost of the home. Always take a realtor when visiting a new build community. For example, I heard of a buyer in Arizona who skipped a realtor and ended up paying $15,000 more because the builder inflated the price to cover free upgrades. Having a realtor could have saved them that cost. A realtor ensures you get the best deal. Let's explore the truth about buying from a builder. Here's the truth about buying straight from a builder. Closing cost assistance can be bait for a higher interest rate, which could cost you more in the long run. A realtor works for you and a sales agent works for the builder. A realtor can help you make the best decisions financially as you build. A realtor is knowledgeable about what to look for during inspections and final walkthroughs. Knowing these truths can save you from costly mistakes. The fifth mistake to avoid is skipping a home inspection. Inspectors check major items: structural integrity, examining foundation, walls, and roof for cracks, shifts, or damage that could indicate costly repairs. Electrical systems, inspecting wiring, outlets, and panels for safety hazards like outdated systems or improper installations. Plumbing condition, checking pipes, fixtures, and water heaters for leaks, corrosion, or pressure issues that could lead to water damage. HVAC functionality, testing heating, ventilation, and air conditioning systems for efficiency, safety, and proper operation. Here's the cost of skipping a home inspection. It can lead to expenses of $20,000 or more. For example, a buyer in Arizona skipped an inspection and later found a cracked foundation, costing $25,000 to repair. Another missed faulty wiring, leading to a $10,000 electrical overhaul to meet safety standards. These examples show how an inspection can save you from major financial headaches. Let's explore the consequences next. Here's what happens when you skip a home inspection. You purchase a house unaware of deal breakers. You lose your negotiating power. You risk inheriting non-structural safety issues such as mold, radon, and carbon monoxide. You miss having a forecast of future repair costs. You're oblivious to illegal or non-code additions and remodels. Don't take the risk. Always get an inspection. The sixth mistake to avoid is skipping the condo document review. Financial health check. Review the budget, financial statements, and reserve fund study to ensure the condo association is financially stable, with adequate reserves, 10 to 15% of funds recommended, for future repairs like roofs or elevators. Bylaws and restrictions. Examine bylaws and rules for restrictions on pets, rentals, smoking, or renovations to confirm they align with your lifestyle and intended use of the property. Special assessments history. Investigate past special assessments in meeting minutes to identify patterns of unexpected costs, which may indicate poor management or underfunded reserves. Reserve study updates. Ensure the reserve study is recent, within 3 to 5 years, to reflect current repair costs and building conditions, avoiding surprises from outdated projections. Here's the cost of skipping the condo document review. It can set you back $10,000. This review is required by most lenders. For example, a buyer in Arizona skipped this step and later faced a $12,000 special assessment for a new roof because the condo's reserve fund was underfunded. Another missed restrictive bylaws banning rentals, forcing them to sell at a loss when they needed to move. These examples show why this review is crucial. Let's see how you're feeling now after all this valuable information. Are you excited? Confident? Informed? You should be. You've learned how to avoid costly mistakes, and with Todd Uzzell's guidance, you're ready to take on your home buying journey with confidence. Don't worry, we're here to support you every step of the way. You made it to the end. If you have any questions, now's the perfect time to ask. Send a message or comment below. For more personalized guidance, book a consultation with Todd at www.todduzzell.com/consultation or apply for your home loan at www.todduzzell.com/apply. Thank you for attending our first-time home buyers class. We're so excited to see you take the next steps toward your dream home. Goodbye, and we'll see you soon.